Hey everybody, this is Scott, Principal Broker at Realty Executives Main Street, and this is 2 on Tuesday. Today we're checking out the top indicator to look for if you want to know where mortgage rates are headed. Mortgage rates have increased significantly since the beginning of the year, and each Thursday Freddie Mac releases its primary mortgage market survey. According to the latest survey, the average 30-year fixed rate mortgage has risen from 3.22% at the start of the year to 3.55% as of last week. And this is important to note because any increase in mortgage rates changes what a purchaser can afford. See how it affects your purchasing power here in this graph. So how do you know where mortgage rates are headed? While it's always difficult to know exactly where mortgage rates will go, a great indicator of where they may be headed is by looking at the 50-year history of the 10-year Treasury yield, and then following its path. Understanding the mechanics of the Treasury yield isn't as important as knowing that there's a correlation between how it moves and how mortgage rates follow it. With this information in mind, a 10-year Treasury yield forecast will be a good indicator of where mortgage rates may be headed. The Wall Street Journal just did a survey of a panel of over 75 academic, business, and financial economists asking them to forecast the Treasury yield over the next few years. The consensus was that experts project Treasury yield will climb to 2.84% by the end of 2024. And based on the 50-year history following this yield, that would likely put mortgage rates at about 4.5% in 3 years. While the correlation between the 30-year fixed rate mortgage rate and the 10-year Treasury yield is clear in the data shown above, for the past 50 years, it shouldn't be used as an exact indicator. They're both hard to forecast, especially in this unprecedented economic time driven by a global pandemic. Yet understanding the relationship can help you get an idea of where mortgage rates may be going. It appears, based on the information we have now, that mortgage rates will continue to rise over the next few years. If that's the case, your best bet may be to purchase a home sooner rather than later if you're able. Bottom line, forecasting mortgage rates is very difficult. As Mark Fleming, chief economist at First American, once said, don't ever try to forecast interest rates because you will always invariably be wrong. However, if you're either a first-time home buyer or a current homeowner thinking of moving into a home that better fits your changing needs, understanding what's happening with the 10-year Treasury yield and the mortgage rates can help you make an informed decision on the timing of your purchase. Hope this has been good information for you today, and this is Scott for 2 on Tuesday, and we'll see you next time. Have a good one.